Are you ready for more madness in the market? Because this week we get the retail sales data, the highly anticipated FOMC rate decision, an updated summary of economic projections, and to top it all off, a triple witching expiration by Friday. So welcome to the Trade Brigade Weekend Show. There's a ton to talk about today, and we're going to make sense of it all. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with just a little bit of a lower wick, which, if anything, would just imply buyers stepped up near the lows of the weekly range, and they were able to close near the highs of the weekly range. So structure is absolutely bullish. If we think about bar-to-bar location, notice the higher low here. It's very nuanced but important. You'll see why in just a moment, as well as a higher high and a close completely outside of and above the previous week's range. So location is also bullish here. Buyers go 2 for 2 on the bar-to-bar count. But it's not just the bar-to-bar count that's bullish. I mean, look at what we're dealing with overall. We've got all-time highs, equal highs, and we've basically closed right back up towards that equal high after setting a big-time weekly higher low from point A up to point B. But this wasn't without concern, because if you recall from last week's episode of the weekly watch list, we had talked about the overshoot and the close beneath the Fibonacci 38.2. We had talked about the overshoot and the close beneath the anchored VWAPs on the weekly time frame chart. So what happened this week is fairly important. We opened over the 38.2. We opened in the anchored VWAP cluster. The sellers tried to make a move in the downward direction, but as we just made note, there was no weekly lower low. So you could say that the sellers failed down here, and of course, the close was very strong in the opposite direction. If we take a look at the volume profile, this would also agree. If we just zoom out here and take a look at the high volume node, this was closed beneath, so the threat had become, okay, what about a low volume void rotation? That would have brought price all the way back down towards 525. It simply didn't take place, and we've closed back up towards these all-time highs. So the weekly chart is bullish as long as we're getting bullish consolidation above that last pivot higher low, which is at 540. And really, we can start thinking about bullish breakouts into blue sky territories if we can take out 565. We'll get more nuanced with that on the daily chart in just a moment. But what about some Fibonacci projections here as we start to move into blue sky territories? What do we have as possible targets? Well, I'd remind you that the cup and handle measured move, not stacked from the pullback low, but stacked directly on top of the cup, is within striking distance at 571. That's certainly a level to be thinking about. And the bull flag from point A to point B pullback C, if we take this measured move, it's much higher. It's at 610 roughly. But this is something to think about as and if we get a blue sky breakout here. Now, this is certainly not in play for the coming week's worth of trade, or at least I would think that there are lower odds of getting there, but those are your upper levels to at least consider here as and if we move into blue sky territories. Let's drop it on down to a daily time frame chart. Let's get a little bit more granular and evaluate this week's expected move. So the expected move is here, and if you're not familiar with this study, by the way, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 572.49, and that of course implies a higher high and a brand new all-time high. If we're contained by the lower bound at 551.59, that would imply a higher low. So the expected move does strike me as being more bullish than bearish, especially considering that there was no lower high attempt underneath the bottom end of this overhead supply on the daily time frame. If you recall from the Wednesday midweek market update video, we were slightly concerned about this, and clearly, as of Friday's close, we're already back at the top of that balance range. So, on the daily chart walking forward, really the most ideal outcomes would be a break and Brigade bolt over. I would say the top end of the balance range here at 562.50. If you can spot higher lows after a breakout, this would sort of give way to the rotation into that weekly target at 570, 571. Upper edge of the weekly expected move is at 572.50. So those would start to become upper targets. If the market decides to pull back first, which would be fine because we're sitting at an equal high, basically the all-time high, anything that looks like this is reasonable for a higher low. That would be off of the bottom end of balance here at 555.50. But I would take it one step further and say that the new daily line in the sand for a higher low is actually off of this level at 549. Why would that be the key level? Because that's exactly where the sellers failed. Remember on the weekly chart, we had talked about that attempt to move lower. That's really here intraday on Wednesday, where the sellers failed to take out Friday's low from 2 weeks ago. So if we stay over this breakout point, the origin of that Friday breakdown at 549, I would still count this as a daily higher low. You would have lows. This sets the count. This, of course, would turn into a higher low on the daily time frame chart, and this would be the next possible daily higher low. So what would be the big cause for concern where, oh my goodness, this is a big failed breakout and the market's really going to move hard in the downward direction? I would start to think if the market gets a breakout into blue sky territories and promptly fails, but not just any failure, fails underneath the bottom of this range from right here at 555.50. Now we've got failed overhead supply on the breakout. You've got failed overhead supply from this balance range. I would say that any lower highs after a fake break to new all-time highs beneath 555.50 starts to become dangerous for not only the weekly equal low, but any breakdown beyond that really starts a stronger trend reversal or a weekly balance, right? So that is the bearish situation. But I would say that as of right now, it seems to be lower odds. So let's get a little bit more granular on the hourly time frame chart. Let's talk more about the price action and the types of participants in this market. So Wednesday, just to recap, was a really large failure from the sellers. Why? Because there's a momentum breakdown underneath the Friday opening print, basically underneath this, which was the gap area from back here, and there was no subsequent lower high set underneath the Monday, Tuesday low. There was nothing at the midpoint of that balance range. There wasn't even any struggle up against 549. So do we have stronger sellers in this market? The answer is no. And as we approach the bottom end of the overhead range, which would have been this level, 555.50, obviously we're above that now. But as we approach that, I mean, we do the dance for a little bit on the Thursday morning session, but look at the Thursday afternoon liquidation break. As I really zoom in here, I want you to make note of the second to last hourly bar from Thursday. The sellers try to make a break in the downward direction, or you could just argue that longs late to the party start to close out all at the same time. But where's the low of that hourly bar? It's certainly well above 555.50. So to me, I mean, yeah, liquidation break, but shaking out some longs with terrible location, not necessarily new money sellers ready to push this market in the downward direction. Friday does start to slow the momentum just a little bit here. So again, it's not unreasonable if a pullback starts to unfold because we do have some fairly thin structure underneath us through this entire rally in the upward direction. So what does the pathing start to look like as we move into the early stages of this upcoming week? And what do we see from an intraday anchored view app perspective? All of those nuances. If we get a break and hold over 562.50, of course, that's just bullish and we're looking for blue sky territories and all-time high breakout. If this makes a move above but then fails into Friday's range, I could start to envision some sort of head and shoulders up here, and your breakdown might be underneath something like 561. From there, it should be a fairly easy pullback through some of this thin structure on the way higher for a better test of 555.50. Remember that risk reward wise, getting new money longs at the tippity top of the move generally isn't that favorable. If the market does pull back and gives us some sort of indication down here, at least we can set up risk reward back in the upward direction that is much more attractive. So I would love to see a pullback into 555.50. And once again, if you want to try to trade this pullback as like an intraday scalp or something like that, there's nothing wrong with taking a short from point A to point B, but certainly at point B, I would reevaluate and say, okay, what are the odds of a double bottom reversal? What do we see in terms of inverted head and shoulders, or even just a simple hourly hammer candle, right? Those things fly. If there's just a knife through hot butter or a hot knife through butter at 555.50 and a lower high here, I would rinse and repeat the same exact process and say, okay, there might be a short from point A into point B, but I would really reevaluate at point B. That would be your 549. That's your daily 50 SMA, the blue moving average on your screen. What do we see here in terms of Fibonacci confluence? Is there anything? Coming from the Wednesday low up to the Friday high, the 38.2 is not really paired beautifully with the 555.50, but it is within striking distance. So anything that's sort of sloppy in here, maybe it's a lower low and then a higher low like this, higher low double bottom that could be bullish for a reversal back in the upward direction off of the 38.2. I do like that the 61.8 is confluence with the 549, also reinforcing that level. Let's take a quick look at the anchored view apps intraday. And what do you know? Same exact thing. So your anchored view app off of Wednesday's low is confluence with the 555.50, reinforcing this zone. This anchored view app is sort of mixed in. It's not that clean with the 549. I would say a similar comment to what we had with the 38.2 in this level. But generally speaking, those two levels are being reinforced by the additional indications that we have on the screen in front of us. The larger breakdown slash failure I was referencing on the daily time frame to show you what the pathing there would look like, it would probably be, okay, here's this break to new all-time highs or something like that. The FOMC comes in and everything completely crumbles. Any lower high here after that type of move starts to get really dangerous, at least into the weekly equal low. That would sort of be my thesis there. So a larger failed break with an FOMC catalyst perhaps and lower high here, not looking so pretty. I would certainly buckle up and get prepared for a bumpy ride. Let's see what the market internals have to show us in terms of additional indications. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Overall, we had substantial volume inflows on Friday. The advanced decline line was in trend higher zone, really strong show from the index score as well. And the cumulative build built into the afternoon, a little dip, but pretty much sustained there. It's not incredible. It's not up and over 5,000, but it's definitely more bullish than it is bearish. The one thing I will make note of is the slight, very, very slight divergence with what's going on Wednesday's session. If you look at the size of the rally and the reversal off of the lows, it brings up some questions as to why was there really not much exchange level participation back in the upward direction. Now, I get it that you're battling back from negative outflows to positive inflows, but with the size of the rally, I really would have liked to see that reinforced with strong flows up and over 300 million, not the case. Advanced decline line, similar story. The only thing going for the Wednesday rally is the cumulative tick, a 45-degree line directly into the close. That would mean at the exchange level, almost everything continued to tick higher into the afternoon bell. So I'm not saying it's a total, like just a short squeeze, don't trust the move, and you are getting the reinforcements on Thursday, Friday, both here, here, and here as well. But generally speaking, if I just go back quickly to the hourly time frame chart, these pullback ideas in here certainly make more sense to me, and I'd like to see the internals very strong if there is a reversal off of these levels for that higher low. If we have internals that are firm off of the next daily higher low, I'd start to think more confidently about all-time high breakouts really being more firm instead of lackluster and with the potential to fail. Let's take a quick look at the market profile of the ES. What you'll note here is that we did get, and by the way, if you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. But on Wednesday, we talked about how the value area was technically left inside of the Friday range here. I know you can't really see Friday. Let's bring that back. Here we go. This is Friday's range of 2 weeks ago now. This is Wednesday's breakout value, and we did get confirmation that value shifted higher on the Thursday session as well as the Friday session. One thing to make note of here is that the value area is pressed into the highs on Thursday, but more central in the profile on Friday. So is it reasonable that a pullback might start to unfold as value doesn't continue to shift higher or as high as it could have? I think the answer is absolutely. An interesting indication here is that we do have poor highs. This one was repaired on Thursday via Friday's low, but we do have a poor high at the top of the Friday move. So if we get any sort of move through that and then come back down into range, that could kick off the pullback that we were just describing over on the SPY cash here, where we get some sort of look above, failure back down into range, aka we clean up the poor high, come back down into range, and maybe that kicks off the pullback to get into something like your 555.50. Let's jump on over to the QQQ NASDAQ 100 and see what's going on there from a weekly perspective. We'll do the full top-down analysis, and we'll keep this show moving right along. So on the NASDAQ, this is the SPY. Let's go to the NASDAQ. Here we go. Let's get a clean drawing set. There's a big divergence that we cannot ignore, right? And this, we've been talking about this in the pre-market prep, but there's this major weekly lower high, and we didn't even really close close to the equal high from a pivot perspective. Now, I'm not going to sit here and ignore the fact that we have an attempted higher low, but this looks much more like range compression to me versus an attempted move to break out into blue sky territories. And noting that the NASDAQ really makes up a heavyweight component of the S&P, the XLK technology sector is the heaviest weight component in the S&P, this doesn't really give me a warm and fuzzy feeling inside per se. And one of the takeaways I would have here is that if the S&P 500 breaks to a brand new all-time high, and this is exactly what we said on the first go around, remember this, right? If the S&P makes a new all-time high, but the NASDAQ cannot make even just a new pivot high, if this just struggles in here and starts to roll back into the previous week's range, that would be a huge red flag in the S&P. I would be much less trusting of that break to blue skies. So let's keep it simple. Let's get back to the basics and talk about candle structure and location and all that good stuff. We do still get the same green-bodied bar, a little bit of a lower wick, a little bit of an upper wick there, nuanced higher low as well as a higher high, close outside of the previous week's range, absolutely, but underneath, and once again, not even close to an equal high at the all-time high. If we think about this to this, higher low as we just made note, but let's double check with our Fibonacci's and see what's coming in here from this perspective. So the 61.8 did hold. That's always a line in the sand. I like that. If the market is going to consolidate or continue to look constructive out of the NASDAQ, I would really want to see the 38.2 hold up as the next major higher low set. So you have lows, higher lows, and an attempt at the swing high, if not a break through that for the all-time high, which would be the best outcome for the S&P 500 to remain optimistically bullish. Let's come in here with the VWAPs out of the weekly. And you can see we've recaptured the cluster, which again is bullish. I'm not trying to sit here and say that, oh my God, the NASDAQ is going to fall off the cliff into oblivion. It's just not nearly as strong as the S&P 500, and that divergence is somewhat concerning. It would have been worse, like the look would have been awful for the NASDAQ if, let's say, off of this low we tried to rally, rejected towards the VWAP cluster, and closed perhaps underneath the 38.2. Obviously, we don't have that. We do have a stronger close towards the highs. So now there's at least an opportunity for some sort of sustained higher low in here, and not just a pure play rejection through these lows and some sort of disastrous breakdown. Let's jump into the volume profile and see if we can learn anything additional about this look here. Let's take a look at this high volume node. It's kind of right where we closed, so not out of the woods from a volume perspective. This could act as resistance, and once again, if there's a struggle here and a lack of a new pivot high on the weekly in the NASDAQ, that's kind of a red flag for the S&P 500. Let's bring this down to a daily time frame chart. We'll talk about the weekly expected move, and we'll continue along with the analysis. So the expected move here is going to suggest that if we're contained by the upper bound, we get 486.50 roughly, and that would be an equal high to the pivot weekly high we were just talking about. That gives me sort of some reassurance. It's not totally great, but it's some reassurance at least. And the lower bound is here at 464.25, implying an attempt at a possible higher low. So really equal highs and higher lows. It's slightly more bullish than bearish, but maybe even leaning a little bit more so neutral, given what we just described on the weekly higher time frame. In terms of the structure here, I really like the break back up and over the 468.35. If the NASDAQ was going to maintain more relative weakness, it would have made sense to me that a rejection in here, keeping price underneath this area, would have been much more bearish. It simply didn't take place. You've got the recapture of the daily 50 SMA, and just like the S&P 500, it's not as strong, of course, but any higher lows that pull back and now hold this level right here, 468.35, are at least constructive for an equal high and then an attempt at the weekly equal high. That would be 483 out of the NASDAQ here. So your key pathing looks like this. Critical higher low needs to be found here, 468.35. Ideally, it rotates to this. If there's consolidation up here, possibly setting the breakout up for a potential move to close the gap. Let's think about this constructively. What did we just say on the weekly, right? If the S&P is breaking to new all-time highs, we want the NASDAQ over the swing weekly high, which is this pivot back here. Therefore, if you get this consolidation and the higher low over 483, that would give me more confidence in the S&P 500 to trade into blue sky territories. The target here on the NASDAQ would be the gap close over 488.50 up to 493.10. If the market's going to really struggle more so here in the NASDAQ, I would say first step is getting price underneath 468.35. This is kind of like no man's land. Then things get pretty disastrous if we were to get a move underneath this 458.50. There was some overshoot here, but the market recovered quickly. You cannot afford for anything to trade back underneath 458.50 in the NASDAQ in particular. Any pathing that looks like this, and then a subsequent lower high here, really disastrous. We already know about the weekly lower high, really opens the door for a breakdown of the weekly equal low. You're trading into the August 5th panic probably spells pain over in the S&P 500. Let's jump on over to the hourly time frame side of things and see what else we can learn. Rinse and repeat of what we talked about over in the S&P 500. You've got yourself a thin structure rally in the upward direction, things slowing down ever so slightly towards the Friday session here. So any sort of look above and fail back down underneath 477 maybe kicks off a pullback. Key support needs to be held here at 468.35, looking for double bottoms, inverted head and shoulders, hourly hammer candles, all that stuff flies. As we just talked about on the daily, any move underneath that, no man's land in here. Now, from an hourly perspective, I might entertain the possibility of something that looks like this, and then a Brigade bolt back over 468.35. The reason being is that you have the 2-day consolidation here before the Friday breakdown of last week. If shorts are going to continue to get pinched out of the market, and if you can spot buyers at the lower edge of the weekly expected move, which is the top of this 2-day balance range, 464.25, the Brigade bolt back over 468.35 then becomes attractive for, okay, you've got yourself a daily higher low from here up to here. The recapture is important, and then we trade back into the equal high at 477. What do we see from a Fibonacci perspective? Let's come in from the low of Wednesday up to the top of Friday. 38.2 within striking distance of that 468.35. The 61.8 is in no man's land, but a 50% retracement is dead on the money with the top of the 2-day balance, and once again the lower edge of the weekly expected move at 464.25. If we clear that up, let's take a quick glance over at the intraday anchored VWAPs. Beautiful, right on. You're getting confluence at the 468.35. Slowly over time, these might march in the upward direction, maybe by like Wednesday or something like that. Midpoint of the week, you're at that 464.25, so all set from that perspective. Let's jump into the NASDAQ internals and see what we can see from this perspective. You'll note, and this is the glaring difference, which aligns with the weekly relative weakness, you did not have substantial volume inflows even on the Friday session. Now, on Wednesday's reversal, though, you did get much more substantial volume inflow, so it sort of counterbalances, in my opinion, suggesting that this is not just short squeeze, but there was actually some substantial buying at the NASDAQ exchange. If you look at the advanced decline line, in-trend higher zone here, and a substantial read out of the cumulative build into the afternoon on Friday, once again, it would appear as though we want to align ourselves a little bit more bullish than bearish, but looking for internals to confirm when and if a pullback unfolds that this area in here is going to offer a strong buying opportunity with good risk reward back in the upward direction, right? Let's jump on over to the NASDAQ market profile and see what we can learn out of this look here. I'd say a rinse and repeat of the S&P 500 where you have value continuously progressing in the upward direction, a little bit more central on that Friday session, poor high as well. Same rinse and repeat indications as the S&P. Let's finish up the broad market with the IWM, shall we? So small caps, let's jump this up to a weekly time frame chart. Let's make sure it's a clean drawing set, and let's begin. So, candle structure and location as we typically do. Green-bodied bar, little bit of a lower wick on it, little bit of an upper wick, hardly anything. So I would say a more similar indication to the S&P 500 structurally. However, location-wise, something really interesting happened here, which actually reinforces a little bit more of a bullish edge, right? So, structure is bullish, but location, notice that you make a new bar-to-bar lower low, and you've also got this lower high to be dealing with, which is kind of a concern towards the top. But if stronger sellers were here, let's put ourselves in the shoes of the sellers, right? If stronger sellers were here, and you broke down underneath the previous week's low after failing underneath this pivot high, it was sort of setting up bearish consolidation back down inside of this balance range right here. Obviously, that did not take place, and the weekly was able to close back above that balance area. So to me, it's a small step in the right direction. I would still argue that your key line in the sand here is around that 210 on the weekly. As long as consolidation can remain above that level, I would say, okay, small progress in the upward direction. You're really still dealing with some kind of range compression loosely in this area. So let's just take a look at a couple of additional indications like the KRE. Just to get a sense for what smaller regional banks are doing here. I like the hammer off of 53 last week. That looks good. We could take a look at XRT, see what's going on with retail, back over its key level. That, again, looks decent. Let's take a look at XBI as well and see what's going on with biotechs over that 94. So these other small cap indications look all right as the IWM is getting into this range compression, but having a weekly close over the top end of this prior range from back here. Let's take a quick look through the lens of Fibonacci's off the lows up to the highs. Notice the close over the 38.2, the hold of the 61.8. That's pretty critical. If we come in here with the anchored VWAPs on the weekly, you can see that we are back above the entire cluster. So kudos to the buyers out of small caps, putting in a little bit of extra effort here. However, my one word of caution would just be that small caps are always more sensitive to economic data. If Jerome Powell comes out on Wednesday and just absolutely rug pulls the market, I would expect the IWM to probably be down the hardest out of the core indexes that we watch. So keep that in mind. Obviously, I can't tell exactly what Jerome Powell is going to say, but we'll talk about the fundamentals in just a moment. Let's quickly come in back on a daily time frame chart and see where we're at from the rock and a hard place levels. Remember that that's this weekly line in the sand. It's actually more appropriately here. We can get a bit more precise, right? At 207.80, and we had this as well at 215. Recall that 215 represented this overhead supply. So the Friday move in the upward direction is actually really constructive back higher. And unfortunately, I know it's like flip-flop, back and forth. I think we can all agree at a high level, IWM is not really doing much. Small caps are not doing much. They're compressing inside of this range. They haven't really made a decision. But if we're trying to take the nuanced approach of saying, okay, what are market participants trying to price in here? The recapture of 215 without all of this acting as overhead supply, offering a lower high, to me, would at least indicate that there are some reduced fears now, after Friday's session, of that R word, recession, right? If everybody was concerned about recession and small caps is not the place to be during a recession, then you probably would have seen a lower high here, a rejection of the 50 SMA, and possibly continued range compression inside of no man's land. Things would have gotten worse underneath 207.80. It's not the case as of Friday's close, so making note of that here out of small caps. Here's the hourly time frame chart. Notice the afternoon consolidation looks healthy to me. It's much more of a firm move in the upward direction versus the NASDAQ and S&P, which kind of went more so sideways on Friday, so I like that out of small caps here. Obviously, your pathing going forward is that any sustained holds of 215 that rotate in the upward direction, you've got the midpoint of this range here at 218.35, but really, the next major location to target is 222.15. That would be bullish intra-week for the S&P 500 if we can continue to hold over 215. The most bearish thing that could happen here is that there's a failure under 215 with a lower high. We close the gap. There's no gap fill reversal. We go down to 210. We set up bearish consolidation, and there's some sort of breakdown either on the FOMC or in the aftermath of FOMC back down underneath 207.80. I'm not forecasting this as like a necessarily high probability outcome. We'll really take it day by day in small caps, but generally speaking, your two must-watch areas are just 215 and 207.80. For now, I would say that the buyers have a little bit of an edge for something that looks like this if we can sustain early in the week over 215. Let's check in quickly with the Fibonacci's from bottom to top. 38.2 is almost confluence with the gap fill reversal. So once again, if this takes place and then you're back over 215, this here, that dot, is probably a long. If you're not, if you get some sort of like, let's close the gap and then a lower high here, that becomes a little bit more difficult, noting that you're in the rock and a hard place zone underneath 215, yet over 207.80. The 61.8 is not really confluence with anything. Let's take that off and quickly check in on the intraday anchored view apps. Slowly the cluster should move over time closer to the gap close area. So 212.85 could be a key level to watch in between no man's land, under 215 yet over that line in the sand at 207.80. Let's check in briefly on the Russell internals here, see what's going on at the not exchange level but index level. Really strong volume inflows on the Friday session, so giving credit where credit is due, decent move out of the Russell. Advanced decline line is well over and in trend higher zone into the close, and if we look at the cumulative build here out of the tick, also a nice read there on Friday. Not trying to be overly counter trend here. I think that the buyers did step up out of small caps, and once again, this comes on the heels of some interesting things going on with the Fed tracker tool. We'll talk about that in just a second, but let's finish it up with the Russell market profile. Notice that on the Wednesday session, value was actually higher in that session, and we confirmed the breakout with Thursday higher. Same thing here on Friday as well. The big takeaway is that instead of value being central on Friday and the point of control being central, it's actually higher out of small caps. You do still have that poor high, so look for a possible break through that to kick off the next leg here out of smalls. Anything that's to the downside, it's all about the gap close area, which would also repair a poor high left in the wake of the Thursday session. Let's get back on over to the platform here and evaluate the sectors of the S&P 500. We'll start to get a little bit more granular. What do we see? Who was leading, who was losing, and where was the weight in terms of weekly performance? Leading the pack is the semiconductors ETF, up 8.45%. It's pretty astounding. However, there's a threat on the daily time frame chart we'll talk about in just a second. Technology is just below, up 6.78%, and then it's the XLY consumer discretionary up 4.43%. What do all three of these sectors have in common? They generally are highly influential over the S&P 500, and they are more risk-on in terms of their nature. At the bottom end of the barrel, it's the XLE energy sector and the XLF financials, down 79 basis points and 45 basis points respectively. Then your next laggard in terms of S&P sectors is the XLP consumer staples, only up, air quotes on that, 1.12%. Now, energy is lightweight, but it's not necessarily defensive. XLP is lightweight, and it is D for defensive, absolutely. But the financial sector is the second heaviest weight sector by market cap. The only saving grace out of financials right now is really the fact that it's holding on to the previous all-time high breakout level around 44, which we'll talk about in just a moment. But generally speaking, posture looks pretty good here as the market's trying to make this rotation in the upward direction. Let's check in on the individual structural charts here. The main threat out of the semiconductors, as we all know, was this head and shoulders. Now, just as quick as this can turn into a head and shoulders, it can also turn into a double bottom reversal, right? It's got to break out over its neckline if it's going to be a double bottom, and it's got to break down underneath its neckline if it's going to be a head and shoulders, which really means that as of right now, you're in a phase of range compression. From here to here, weekly high or low. From here to here, weekly low or high. And as of right now on the daily time frame chart, if we're really starting to pick apart the levels, if we're underneath 237, I would unfortunately tend to think that the semis might be in store for a pullback here. And again, range will continue to compress if we find a high or low over 228.50. Now you're dealing with something that looks like this and something that, of course, looks like this, and we'll see which side of the triangle breaks. But generally speaking, early on in the week, if semiconductors pull back off of 237, which is really just the bottom of this mild, like, this was a slow and steady pullback. This is that acceleration, right? If this is going to act as overhead supply from anyone who is at first glance thinking of this through the lens of bull flag, which, don't get me wrong, was a very reasonable thing to do at the time, if that's going to act as resistance, once again, early on in the week, I might have some concerns about just straight up continuation out of the S&P 500. If semis are rejecting 237, I'd really say that's a top watch. So 237, SMH, big watch here for both the S&P and the NASDAQ, really. Let's jump into the XLK, which is going to be very similar, where you've got the threat of left shoulder, head, right shoulder perhaps. Your neckline's way down here at 192, so that's not really in play. If this is going to turn into a double bottom, your neckline's well above, up towards this gap. Now, the best thing about the XLK, and what's really helping out in the S&P 500, is the fact that there was no rejection on Thursday or Friday at this 218, right? 218 is the equivalent of the SMH 237 level. So as long as price can hold over the 50 SMA, as long as price can hold over 218, the gap close is really the next major target overhead, and that starts to put into play, once again, that double bottom we were just referring to. Things would become more concerning if there's a pullback that does not find a higher low off of 212. Why 212? Well, look left, it's the bottom end of this balance over here. And just as a reminder, because I know the daily looks a little bit funky, 212 comes from this. The rejection here and the rejection here, the support there, right? So although it looks kind of funky with those daily lower wicks that are below, we want to stay above that level, right? We ideally want to stay above this interaction here, and from here. Let's go back to some dailies so we know what we're looking at. We're all set out of the XLK. Let's jump into the XLY. This chart to me is really constructive. I like the breakout of this balance range because now we're starting to suggest more of an equal high on the weekly time frame chart. You could get a daily or weekly high or low if we support over 188.75, the balance highs of that breakout zone. And then, of course, any equal high attempt in short proximity of time should continue to get this move going in the upward direction. The next major overhead level, there's some room to run. Recall that off to the left, as you know, in anything that's not made new all-time highs yet since the 2022 drawdown, that was a very volatile time period in markets. So these ranges overhead, they might look really large, but structurally, that's all that we've got. Now, I'm not saying that this move is going to happen in the blink of an eye, but generally speaking, it should be more difficult to find resistance in this zone versus just move through it with, again, cautiously trying to use my words here, not ease, but, you know, there's no like, okay, here's the major threat. Watch out for this level. It's right there, right? So that's the top watch out of the XLY. I like the breakout of the balance range and the opportunity for support here at 188.75 to be constructive for another building block in the upward direction. Let's move along to real estate. Not much to talk about here. Obviously, with rates coming down, we've got real estate moving higher. Lightweight sector. Let's jump into communications. Would love to see this break to new all-time highs if the broad market's going to make it to new all-time highs. It's not the heaviest weight sector, but it's definitely more risk on than risk off. I think that this has the opportunity to get in gear if things like, honestly, Google can get in gear. If Google can start breaking out or at least playing catch up to the technology sector, I would think that this has some opportunity to move in the upward direction. Let's jump into utilities. Utilities, a nice breakout to new all-time highs. Upward pressure is upward pressure, but yes, let's absolutely acknowledge that this is D for defensive. We'll take a look at bonds in just a moment. As we look at the industrial sector, back up towards the all-time highs, pretty hard-pressed to say anything bearish about that. Materials towards the top end of its balance range here. Again, upward pressure is upward pressure, but it is a lightweight sector. The most meaningful thing would be a breakout there. Here's the XLV healthcare sector, third heaviest weight by market cap. Loving the higher low that's being put in. I like the fact that on the Wednesday session, you sweep these lows and then close back inside. Looks great for a higher low opportunity. Any equal highs and breakouts will be bullish for the S&P 500. Let's jump on over to the XLP consumer staples, all-time highs, consolidating, starting to break out. Yes, absolutely. Bullish pressure, but as we know, D for defensive. Let's acknowledge that when we have to. If the market continues higher and it's not being led by semis, technology, discretionary, and these names like the XLP or bonds like we were just looking at, sorry, not bonds, but utilities, which are a bond-like sector, if those names continue to propel the market higher while the risk on sectors are not moving higher, that starts to become more of a red flag. We don't currently have that situation. The TLT bonds, here we go, the 20-year, is certainly trying to break up and over this level. Once again, making sense considering what we know about the Fed and their likelihood to cut rates. Then we can jump into energy, which continues to be a concern. One of my issues with the XLE is the possibility of a lower high here, continuing to signal the global slowdown in demand for oil, right, really, which is sort of an indication that global economies might be slowing down a little bit, which comes sort of at an appropriate time. We know that the ECB has cut rates now twice. Jerome Powell is very likely going to give us some sort of rate cut on Wednesday. We just don't know by how much. So we'll see if that can spur some demand back and see if we can get growth moving back in the upward direction. But even looking at something like the crude oil futures, if we use a slash, not a dot, that should help us out here. The big watch I have is just whether or not there's a lower high underneath this zone that we've sort of mapped out in here. If price remains underneath 70 out of the CL, I would tend to think that, once again, this global slowdown is kind of underway. If we can get over 70 with a Brigade bolt back into this range, maybe the rate cuts from the Fed as well as the ECB are really starting to do something and prevent that global slowdown and that big dirty R word, the recession, that everybody's talking about. Let's jump on over to financials. As we can see here, the big defense of 44 stepped in on Wednesday. I like the fact that we're sustaining over it into the end of this week. So far, so good. I like the hold of the daily 50 SMA, the move back over the flat top. As long as this can hold over 44, I ideally would like to see this rotate back to the highs. I would become more concerned about the XLF if there's not only just a break underneath this level, but more of like a gap fill reversal and then a lower high. If that starts to emerge, now you're dealing with, okay, what are the opportunities for a head and shoulders? And even if it doesn't cause a hard reversal in the downward direction, any stagnation through this area, we know that financials really kept the bullish pressure on the S&P as the tech sector struggled, really off of the August 5th stuff. So the slowdown in financials would cause, in my opinion, some concern for the S&P 500, watching that 44 level mainly like a hawk here. Let's jump into the ratio grids and see what's going on a relative basis compared to the S&P 500. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Notice that the XLK has seen a decent move off of the lows, but is flattening here. That to me is a threat for a possible lower high underneath a downward sloping 50 SMA. I'm not going to say it's doom and gloom. It's, oh my goodness, the market's going to crash, but it's not firing on all cylinders on a relative basis when we're thinking about risk on and risk off. So this is an issue. This is a red flag. XLF needs to hold the higher low at the upward sloping 50 SMA. Otherwise, we just noted our concerns on the structural chart. I like the break out of the XLY a little bit more firmly over this previous pivot high and more close to an equal high with what we had off to the left. The next step is to continue with a higher low and looking for movement in the upward direction. The risk off sectors are not totally pointing in the direction we want yet. Notice the opportunity for an uptrend to sustain itself here as well as here. Ideally, these make some sort of lower low underneath these areas that we're clearly mapping out on the charts right now. So watching that, I would say the main takeaway of the ratio grid is that we've seen improvements, but we're not fully to a risk-on style look yet. Let's take a look at the risk-on versus off specialized ratios, and we'll see a similar story over here. Much more range compression with the opportunity for a lower high. If we could break to a higher high, great, bullish the S&P 500. If the XLU relative to the XLK wants to break for a higher low over the double bottom neckline, great, more bullish for the S&P. We're not there yet. Apples to apples, same thing here. XLY, XLP, got to get over that neckline. Close, but no cigar yet. And the SMH XLV ratio, it's starting to make some strides in the right direction, but once again, just not firing on all cylinders when it comes to risk on. The next thing to note is the continued watch for the Japanese yen carry trade. We've made substantial new lows, but yet the market continues to push in the upward direction. And the reasoning for that, again, the whole point of covering this is that if you look at the, N225 JP, there it is. The Nikkei has sort of seen a solid rebound off of this key level. And even if we just flip this over to a quick candlestick chart, this to me is the primary driver for that yen carry trade. Now, I know it's not exactly the mechanic that everybody talks about, but if the Japanese stock market itself is not, the index isn't breaking down aggressively, making new swing lows, then I would tend to think that the yen carry trade, not that it's over completely, but it's just not as meaningful as a narrative right now if this is trying to find some sort of weekly higher low at the index level out of the Nikkei, right? So that's my sort of take and interpretation on that one. Let's jump into, we haven't looked at this in a little while. This is the NASDAQ versus small caps relative performance. I like the fact that this is stagnating here and it didn't accelerate in the downward direction. If it did accelerate, that would have been much more of a concern about the relative performance of the indexes. It would have been more bearish. If we look at something like the dollar, we know it's continuing to stagnate down here, likely to drop lower as interest rates come down. Mostly the market's priced that in already. It's towards the lows of a very long-standing balance, but generally speaking, we'll watch very closely to see if there's price acceptance under 101 in the Dixie. Let's take a quick look at gold, which is moving pretty firmly in the opposite direction, breaking out of the most recent balance range up here. You could start to take this as a little bit of a sign of flight to safety ahead of the FOMC. This to me is a small signal of risk off. Small signal of risk off, seeing gold outperform like that. Let's jump into interest rates, which we know continue to grind in the downward direction. Not a shocker over here. And the inverted ZT does the same thing, continuing to drop in the downward direction with the highly anticipated rate cut coming on Wednesday of this upcoming week. Let's jump into the Fed tracker tool, though. Speaking of, this is incredible. This is absolutely incredible. After the data came out with CPI, PPI, and even the labor report, which was, not the full labor report from last week, but rather the initial jobless claims and the continuing claims, we had something like 80-20 odds here, but they're dead set on 50-50 odds as of right now for a single versus a double cut on Wednesday. And I think that this is just totally gross mispricing from the futures market. And, who am I to say the pricing is going to be what the pricing is going to be? But if I think about this logically as to what's been going down here, Jerome Powell needs to be playing like 4D chess at this point. Why? Because if we think about all of the indications that came out, we know that CPI didn't really move in the direction we wanted. I mean, yes, on the headline number, at first glance, year over year, great, 2.5 versus 2.9 previous. But anybody who actually took a second look at the report saw that basically shelter inflation is continuing to move in the upward direction. We made note of this over here on X. We talked about it in the pre-market prep, right? You can see here as I enlarge this, we moved from a 0.4 to a 0.5. The annualized shelter inflation is currently at 5.2%. And this is a heavyweight component of the inflationary read. So I don't know how the Fed can sit there and say like, hey, we're on a very confident path to 2% inflation if this is the case with shelter. I'm not seeing it. So any sort of move out of the Fed that signals a double cut would instantly spur, in my opinion, some sort of rebound in inflation. You're going to get goods inflation coming back. You're going to get shelter inflation bouncing back in the upward direction. The only counter argument that I think logically makes sense is that if you lower the cost of financing, maybe people will build more, and more building obviously puts more supply on the market, and maybe prices will come down. But that's a phenomenon that's going to take at least a year to play out. So I think the initial move of a double cut would be to resurge inflation. I think that would be a huge policy mistake. So that's my take. That continues to be my fundamental take. And we can even look at more data. If you look at the initial versus continuing claims, yes, they saw a small uptick this last week, but generally speaking, they're rolling over to stable up here. They're not continuing to accelerate in the upward direction. The only news that came out on Friday was the University of Michigan sentiment studies. This is the inflation expectations first, then we'll get sentiment. Generally, this came in the downward direction, but it's still at 2.7%. And remember that expectations of inflation literally drive inflation. So I like the fact, absolutely, don't get me wrong, I like the fact that the trend is moving lower, but it's not at 2%. Absolutely not. I mean, I would like to see this. You can see historically, it's a little bit more comfortable down towards like 2.5%. So we're working our way there. Maybe that's a decent indication. If we look at the consumer sentiment here and consumer expectations, they saw a slight uptick, which is bullish. Again, we'll give credit where credit is due, but I don't think any of this should be enough reason to really price in 50-50 odds with the inflation issue that we've been dealing with. Right? So what does this boil down to? There's a lot of speculation. Everybody knows that Nick T is the mouthpiece of the Fed over at the New York Times. If you look at what he released on the 12th, it really boils down to this paragraph right here, right? I don't think we're in a spot that really shouts out for a preemptive 50 basis points, says Faust, but my preference would be slightly towards starting with a 50, and we know that Waller said the same thing. Chris would prefer to start with 50 basis points and then dial it down to 25 basis points. I don't see the logic for front-loading cuts. I think it's really going to spur inflation back. Once again, maybe I'm wrong on this and I'll have to eat my words in hindsight, but that's currently where I'm at. And I think the Fed really spurs a stagflationary environment if we start to see a 50 basis point cut. Inflation resurges. Obviously, maybe you save the labor market a little bit, but there's not really much growth. I'm not seeing it. I'm really not seeing what we have or why the reasoning would be for a 50 basis point. I know a lot of people are saying the Fed's behind the curve. You know, housing inflation is going to collapse sooner or later. In the data, we're literally not seeing it. So, that is my take there. In terms of what's upcoming for this following week, we all know that the main event is, of course, going to be the FOMC on Wednesday. But retail sales come out on Tuesday morning at 8:30. We'll have coffee and donuts up in the penthouse for that. And then, of course, here it is, main event, Wednesday, 2 o'clock as always. We're expecting the Fed funds rate as of right now. It's a toss-up, literally 50-50 as to whether or not it's a 25 or 50 basis point cut. And I think the most important thing to make note of this as traders, so let's put our fundamental hat away for just a second. As traders, what does this mean? The market's going to be shocked regardless which way Jerome Powell goes. If there's a 25 basis point cut, everybody who wanted a 50 is going to be absolutely livid. If there's a 50 basis point cut, everybody who wanted a 25 basis point cut is going to be absolutely livid. So with 50-50 odds, there's really no path forward to satisfy market participants. I think this is quite literally one of the only times in recent history, I'm talking about the last 2, 3, 4 years at this point, where we've had such a split decision on what the Fed is going to do. Everything else has pretty much been like, okay, the Fed's telegraphed easily enough what's going on. The first cut in the cycle being a 50-50 at 25 versus 50 basis points, I don't think, there's going to be an adverse reaction no matter how you slice the cake here, because one half of participants are likely to be disappointed. So what does that mean again as traders? Expect volatility, expect disappointment. Markets do not like uncertainty. I'm not saying that the market needs to crash here, but what I am saying is I wouldn't be shocked if the market does make an attempt to pull back. Now, we're still going to rely on those S&P levels that we were talking about, but that's going to be a big watch. Wednesday at 2 p.m., there's going to be some serious fireworks, in my opinion, going off in the market. Now, something that the Fed can do to sort of bring the market back down to earth and say, like, okay, don't worry about what we just did, it's going to be okay, is if they go in with a double cut, they could come into the SEP, the Summary of Economic Projections, and really soften the continued expectations. If they come in with a 25 basis point cut, they could make the economic projections a little bit more aggressive. If you're not familiar with the SEP, it's this document right here, where the Fed basically outlines what they believe the median will be for either calendar year 24, 25, 26, right? So if the Fed gives a 25 basis point rate cut, but down here they price in, hey, we're expecting to get to a median rate of 4.6 on the year, or by the year end basically, then that would be okay. Probably, an underlying dovish tone, but a hawkish 25, not the extreme of the 50. So I think that the way they manipulate the SEP is going to be incredibly influential over to how the market reacts. So Do we want to dive into this, or do we want to just trade the levels? As an intraday trader, I think trading the levels makes the most sense. But in hindsight, we'll be able to explain why the move happened once we analyze the updated SCP. Once again, that comes out on Wednesday at 2 p.m. Eastern Time. Let's talk quickly about earnings insights. They offered a very interesting chart in their report this week, which is just that the number of companies citing inflation pretty closely mirrors what was going on with quarterly CPI. Notice the uptick here, the rollover as people talk less and less and less about inflation. So that just struck me as interesting. There's not been much change. Adobe was the only major company that reported last week. This upcoming week here, we have FedEx. They typically have some decent insights considering that they're basically a funnel for demand, right? They have a very good pulse on how the economy is doing with all of their different shipments. So FedEx, after the close on Thursday, will be worth watching out for. Let's finish up the video here with a full look through the risk on and risk off charts in terms of risk appetite. The TLT ratio to the S&P remains somewhat stable and sideways up here, but recall my take is that if we break out over this 1.9 previous pivot high, that would be more of a concern for flight to safety. If this makes a new swing low, I think it's just going to continue to trend in the downward direction like it has done in the past, and we have, no flight to safety really unfolding. Let's jump into bonds relative to themselves, continuing to move in the downward direction. Duration risk is fine for equities down below. If we take a look at credit spreads, continuing to move sort of sideways as they've been doing over the last little bit. The fact that they're not really perking up as the Japanese yen is sort of continuing to make new lows does strike me as a decent and bullish indication here. If we look at the HYG in isolation, we'll continue to point out, and this question is just so, to me, it really tells a really strong narrative, right? And this is big shout out to Chris Shavako for him always reinforcing this. But if market participants felt that a huge recession was right around the corner and corporate earnings were going to take a massive hit, why would the bond market be pricing in a positive divergence to equities down below? And if you're like, well, this is junk bonds, Matt, and the HYG, fine. Replace it with the LQD, corporate grade bonds, right? Even better. Look at the bullish divergence over here, another higher high into the end of the week. I mean, market participants in the bond market are generally speaking considered more sophisticated, right? So if the bond market's moving like this, I think that supports more of the move higher we've seen out of equities. And maybe, just maybe, I'm not calling for this outright, but I'm trying to keep, tabs of all the narrative in my head. Maybe the NASDAQ lower high on the weekly gets taken out if we continue to see corporate grade bonds move in the upward direction, offering a positive divergence. Just something to think about. Just something to think about. Let's continue along. Here's Bitcoin making a move back in the upward direction, but not inside of the overhead range. If it does pop into the range, that of course would be more of a risk on indication. Let's take a look at the total breadth, seeing a big uptick this week. Notice that new highs versus lows made a new high. Notice that the moving averages saw an uptick after what was a fairly substantial threat to the downside after the breakdown of 2 weeks ago, right? Let's take a look at the RSP and see what's going on over here on Wednesday. We made note that, hey, this looks pretty good. Look at the lower wick that looked underneath this low, the close back up at the high. If this broke out over 172.50, we were going to be bullish in the S&P. And that's exactly what sort of unfolded here from a breadth and equal weight perspective. No change in the NASDAQ equal weight or industrial, so let's jump on into volatility. Collapsing here towards the 15 handle. I don't think you get underneath 15 as long as the Fed still is looming on the horizon. So I would expect prior to the Fed maybe some upticks here. If we get over 2050, I would start to become more concerned about a stronger downdraft in the S&P. And we could sort of watch some backup indications here as well, like the VVIX, of course. If this breaks up and over 120 ahead of the VIX getting over that 2050, that would be a red flag. And you could take a look at volatility indications out of the futures. Note that this will roll in the coming week. There's going to be an expiration here. If this sees a move in the upward direction, fine, not a big deal. If this moves under the zero line as we come into this witching, starts to become a little bit more concerning for that S&P 500. Absolutely. You get into backwardation here as we head into the Fed. Certainly that uncertainty. I want to really lean into that word uncertainty. It's the market not liking uncertainty. Doesn't really matter, Fed one way or another, 50 basis points, 25 basis points. What matters is the uncertainty that surrounds it. If the Fed goes with 50 basis points, it sort of signals, hey, we're sort of worried about the recession word. If they do 25, they disappoint everybody who wanted 50 and says that they're behind the curve, right? So there's no way out from the Fed. But any sort of volatility move under zero in this specific relationship Backwardation means that it's likely going to be more difficult for money to flow into the market and cause a move in the upward direction. The one-day VIX is really just sitting right on its key inflection point at 1275. I'll be watching early on in the week to see if this upticks. I imagine it will, considering the uncertainty around the FOMC event, as we've been beating the drum. Let's jump on into the core list of companies and see what's going on from this perspective. Apple is up first on the chopping block. A little bit of a balance range down here. Not much to say in terms of constructive trends going on. So take this one day by day. I wouldn't really want to get involved in here. I think that the next clean bearish trade is underneath 218.50 into the breakout level here at 214. If the market's going to signal some sort of double bottom like this, you've got to get over the neckline at 225.15, and even beyond that, you've got the top end of the range to be dealing with. The better long trade is probably something like this in the grand scheme of things. So you've got this really long, outstanding balance range here on the hourly chart. You can see it as clear as day. Be my guest if you want to trade around in this chop, but it's really not been fruitful to watch Apple too closely. So I'll keep alerts here for some big moves underneath the pivot points, but nothing to really say about the move so far. Microsoft, nice new swing high. Let's go to a daily chart first. Nice new swing high is triggering a double bottom here on the daily over this level at 425.25. So very simple chart to watch here. As long as we're over that level, bullish consolidation. You can walk the levels up from there, 440.65, 448. If the market pulls back below that level, it's not the end of the world. I would want to see a daily high or low up next over this previous pivot high at 419.75. Here it is on the hourly time frame chart, clear as day. This consolidation is bullish. Brigade bolts over 432.15. Walk your upside targets. If you get consolidation that looks like this, sorry, not really consolidation, but rather a bearish move like this, you could maybe trade a quick scalp short from point A to point B, risk reward that possibly looks like that. But generally speaking, this area is an opportunity for a big time daily high or low. That's 419.75. So the main watch would really be something that looks like this. Double bottom here, then perhaps Brigade bolt back over 425.25. So you could long this, you could long this. And again, risk reward is here and risk reward is here back in the upward direction, right? So that's Microsoft. Next up is NVIDIA. And once again, a lot of this analysis will be valid prior to the FOMC. We'll really have to do a strong reevaluation after the FOMC, considering the sort of how large of it, this is a monumental moment for the markets, basically. NVIDIA back over this key pivot point inside day on the Friday session. So inside bar rules in force. If you take out the inside bar high, looking for upside into 124, the bottom of the overhead range. If you take out the bottom of the inside bar, I would tend to think that I wouldn't really be short into 115.75. It's the low of Thursday's session, but underneath 115.75, this is a thin structure retracement into the breakout point at 109.50. If that's the case, let's call a spade a spade. We've got ourselves a daily lower high brewing, but also range compression, possibility for a higher low, right? So this is a tricky chart to be dealing with. It's not really trending cleanly. Here it is in the hourly time frame chart. Overhead supply will be in force if, again, you maybe get something that looks like this, thin structure retracement. The short setup probably looks like this, risk reward wise, for that rotation into 109.50. A good confluence piece for NVIDIA will be the SMH at 237. If 237 fails out of semiconductors, the ETF, I would probably look for this out of NVIDIA, right? Reevaluate at 109.50. Next up, we've got Google, daily time frame chart. We know that this is the major laggard. There's just so much relative weakness here, the massive lower high. I'm honestly surprised with the move on Friday, the quick recapture over 156.50. Now, I get it. It's the laggard. Maybe people are trying to pick it up for a relative weakness like divergence play and trying to get more of that rotation to the upside, the catch-up play, if you will. But the daily 200 SMA is there. The magnitude of this breakdown was much more severe. This overhead range is certainly there. I don't really love Google on the long side here, to be honest with you. And on the hourly time frame chart, I've got very specific conditions that would be required to trade this back in the upward direction or continue to trade it in the upward direction. My primary outcome would be that this turns into some sort of double top and we get some sort of Brigade bolt back underneath 156.50. And what you'd have is a trend, counter trend move in the context of an existing downtrend, and then we'll look for that continuation play in the downward direction to close this gap, make an equal low, and possibly continue beyond that. To be long here out of Google, I'd love to see a full day's worth of consolidation, accepting price over 156.50, or some sort of attempt to move lower that then Brigade bolts back over 156.50. It's not a long here, but I would pay very close attention to this 158.75. If you get this sweep and higher low above, or just a straight up full day or two's worth of consolidation above, maybe it's a quick trade here from point A to point B, 161.75, to get this thin structure retracement. But that's really it out of Google, considering where we're at in the context of this previous balance range over here. Next up, we've got Amazon. What's going on with Nancy? Big new pivot high. Love to see it. So very straightforward, almost more so like Microsoft, but I actually like the Friday bar more so out of Amazon. We looked over Thursday's high, closed back in Thursday's range. To me, that starts to indicate more of a pullback being likely. So intraday, first step is to see if 185 does anything. Any consolidation up here, let it be. It's a bull flag, and we'll watch for bullish outcomes over 189.50. Next overhead target is 195.75. If we drop 185, I would look for the short from point A down to point B, but at point B, absolutely reevaluating for long entries and not wanting to be short anymore. Note the big pivot high, right? This is what we were just looking at on the daily. So if this pulls back, it's really more about where's the long off of 181.50 to pick it back up in the upward direction into the most recent high. That's Amazon. If things are going to become more detrimental, I would say that this starts to become bearish consolidation. This failure underneath 178.50 is kind of key for the sellers to rotate back down into this range here. Next up is the metaverse. Let's go back to a daily chart here and evaluate. I like the move in the upward direction, honestly. It's just all about the next sort of follow through up and over these previous inflections, right? You can see previous support, then clear as day resistance, Thursday, Friday, 524.25. If you can get a break of the 2-day range more firmly in the upward direction, target's going to be here at 537.25. If you just stay sideways in the range, let it be. Starts to suggest more of an inverted head and shoulders. We'll watch this over time. And the bears, I would say that they have something going on underneath this 508, which looks kind of dim on the daily, but here it is on the hourly. So this consolidation is that right shoulder for the inverted head and shoulders. This starts to become concerning, but I think there's an attempt, one final attempt for the buyers to try to preserve a higher low over that 508. If we're under 508, I think it's look out below underneath 499, 500, the nice round psychological number. Next up, we've got Tesla. What's going on with Mr. Musk and the rocket ship? I love the daily chart here out of Tesla. Love the daily chart because this is starting to suggest double bottom. And I also like the fact that the huge bearish engulfer, remember that day was down 9.4% as measured from the opening print. Obviously, all of last week was inside of that range, but it got zero follow through. Let's think about that for a second. Zero follow through. This would have been a failed break of this level, which could have been the neckline, right? Failed break of the neckline, closed weak towards the sort of second portion of the double bottom. Any consolidation down here, any attempts like this near the 200 SMA, the door would have been open for downside. The fact that this moved back in the upward direction so steadily in a grinding manner means that it's not just that we had like a squeeze back in the upward direction. No, buyers stepped up here and were able to move price firmly back up and over this into Thursday and Friday, 226. So any consolidation that continues here, it's all about the overhead gap closing off of some sort of like ascending triangle indication at this point. And again, the big tell is the zero follow through from the sellers off of the lows of that Friday breakdown, down 9.4%. Let that sink in, right? Where's Elon Musk with the sink at the Twitter HQ? So anyways, consolidation in here, looking for Brigade bolts over the 234.15 to close the gap, as we just mentioned on the daily, up at 246.25. If we slip below 226, I wouldn't call it the end of the world. It's more so just consolidation. I would tend to think that the market gets a little bit choppy here in Tesla, just being inside more centrally the range of that Friday breakdown. Next up, JP Morgan. Big move to the downside on Tuesday with the comments from the good old CEO there, Mr. Demon. And his board and other vice presidents and so on and so forth. But soft guidance going forward for Q3, sort of setting the stage. Generally, this move doesn't look great down here, noting that on Thursday, there wasn't much follow through over the hammer high for thin structure retracement. Still underneath the daily 50 SMA, any consolidation that's weak down here is really just a bear flag in the grand scheme of things. Next major target is through the August 5th breakdown lows at 193.75. So not loving the current structure out of JP Morgan and certainly taking that into account because it is basically the heaviest weighted constituent of the XLF sector. Here it is on the hourly. And once again, this is sort of your double bottom. This would have been your daily hammer candle here. Lack of follow through on Thursday. Friday opens back above that level as well. Nothing to the upside, falling back down into range. Bear flag consolidation until proven otherwise. I wouldn't really want to execute in here. The trades really turn into basically looking for a range, something over 207.75 or continuation to the downside, more likely underneath this low here at 201.65, noting the failure of the buyers here. So downside is the preference. Next up, we've got Netflix trying to make a rotation back into its flag range here on the daily. Trendline traders are probably looking at a breakout to some degree out of this flag here. Nice engulfing day on the Friday session. So the next watch is very clearly just up and over the all-time highs for a Brigade Bolt blue sky territories. On the hourly time frame chart, there's a couple of pullback levels that are still valid. I would probably adjust this higher actually into like 689.25 perhaps. That'll do as a nice round number, and we can eliminate this. So this type of idea here might be a long for risk reward that moves to the top of the flag, but the best outcome here would just be clearance of these previous pivot highs at 703.50 into blue sky territories. For sellers, you've got to get some kind of big, larger failure, I should say, back down underneath 679.25. Last but not least, AMD, and then 2 trade ideas, and you're on your way for the weekend. What do we see out of AMDizzle? Really magnificent performance into the end of the week. Honestly, I like the reversal out of Wednesday back over this pivot. The idea for me would have been, okay, if we can get a pullback to retest that, this would have been a great long opportunity for something that looks like this. Obviously, the balloon just continues to float away in the upward direction. So as a trader, we can't really chase it. We've got to make sure our risk reward is in check before trying to pull off entries here. I would say that any continued consolidation over 150.75 is just inherently bullish, of course. I would prefer to see a break and lower high underneath. I don't know that I would try to short it through this thin structure. You can try. Be my guest. There's nothing wrong with that per se, but I'm a little bit more interested in the opportunity for a potential pullback long still off of that 145.25. Some risk reward that looks like this back in the upward direction to the equal high, right? So that's my take out of AMD. If it's just consolidating up here, it will likely be a patience play until we have a new setup, maybe a multi-day range that starts to break out, and we can look for upside targets, or breakdowns will be the same. Actually, I would say if we get 2 or 3 days of sideways and then there's a range break like this, I'd be more enticed to trade the short from, let's say, point A to point B if there's more opportunity for overhead supply. So just make note of that. All right, 2 trade ideas for you. First one, sticking with the A's. Actually, all of them are A's here. We have ABBV for ABBV, right? ABBV. What do we see out of this? This is a healthcare stock, so remember what's going on with the XLV sector. It looks fine, right, for a daily high or low. I like the sweep of the lows here in the lower wicks of the Thursday and Friday session. Friday's an inside bar. We have this equal high. If we can break out over 194.80, I think it's very simply put, a look below and fail. It's a very minor one, but look below, fail back into the range. Higher low is basically implied via the lower wick of Friday. Over these highs offers an entry point for a rotation back up to 199.50. Here it is on the hourly time frame chart. Note the volatility and such, lack of follow through from the sellers, second chance, lack of follow through over this sort of origin of the most recent breakdown. I would tend to think you can retrace some of this structure. If you want to mind the intraday target, use the opening print of this bar at, I guess 197.70 will fly. It's basically the exact level, and we can round off to a dime, no problem. So that's ABBV, possible bullish trade here. I would not be interested if the chart just consolidates here and starts to drift underneath 192.25. Absolutely off the radar under those circumstances. Next up, sticking with the A's, is ARM. We probably should have done ARM first because it's more related to the semiconductor sector, like AMD, of course. But here it is on the daily time frame chart, triggering, of course, a double bottom into the end of last week. Bullish 3-bar play breaking on Friday. So the trade idea is not necessarily to chase this thing long here off of 150, but rather if this can pull back, I mean, what an opportunity for a Brigade Bolt higher low over the retest of the neckline of this double bottom, right? So at 138.75, we've got a top watch. If we take, and also note the opportunity for the pullback, right? Bottom of this overhead supply. It would be very reasonable for the market to slow down here a little bit out of ARM. So here it is on the hourly time frame chart. Notice the high and tight consolidation into the afternoon. Doesn't look like we have immediate indications of sell side pressure, but how could this potentially unfold? Look above, fail back below 150, possible head and shoulders pullback, then you're looking at 138.75. Double bottom here, looking for risk reward that does this, and possibly ballooning runners higher. If this just opens in range and breaks underneath the flag lows, great. There's your pullback. Here's the double bottom perhaps. It could be an inverted head and shoulders. It could be a simple hourly hammer candle down here. Any sort of support around 138.75. Very interested in possible risk reward longs back in the upward direction. If this breaks and holds over 150, like AMD, it almost just turns into a patience play looking for the next setup, but I do like the structure if there is some kind of retracement into that double bottom neckline. That's going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. We, of course, will be live on Monday morning, bright and early at 8 o'clock Eastern Time here on the channel for the pre-market prep. We hope to see you there. With that said, I wish you a green trading week, and as always, I will see you in the next one.